Well, whether you're a first-time home buyer or a seasoned investor, the mortgage approval process can be a little bit overwhelming, to say the least. Here to guide us through it all is financial advisor Mike Bonds. Welcome back, Mike. Thanks so much for coming in. So I wanted to ask you about what is called deleveraging. It's a term that we're hearing a lot about these days in the lending industry. What is it?
Well, deleveraging, leverage is just another word for debt. It's when companies borrow money to make their companies grow. Individual folks like you and I can borrow money to basically the same thing. We can use it to our advantage to get things today that make our life better or that can increase in value down the road. So leveraging is just like borrowing. It's just another word for debt.
Okay, but here's the question. Why would you want to borrow on debt?
Well,
That's kind of scary.
It's a great
scary,
question.
scary thought.
Great question. If you use it wisely, though, it can work to your advantage. You can, as I mentioned, you can get things today that can increase your life. But we also use a rule of thumb because the key is determining how much debt you can take on.
Okay.
So the rule of thumb that we use is a 28-36 rule.
Okay.
The first number, 28, is the amount, 28% of your pre-tax household income that you would use towards your home debt. That would be your principal payment, your interest, insurance, and maintenance.
Okay.
The second number, the 36, is the amount of your the percentage of your pre-taxed income that you would use for your overall debt. So credit cards, car loans, and home debt. If you use that as kind of a guide, that will keep the debt in a controllable manner for your household.
And are you seeing folks do this more often?
They probably don't use the rules as much as they can because there's a couple of different ways that we can use debt to our advantage. One of those is buying a house using mortgage or home equity lines of credit. Very familiar to most folks that are out there. Mortgage debt is great not only because it's got a low interest rate, historically low interest rate, but you can write off the interest up to $1 million on your primary residence and your secondary residence.
Get a little bit of a tax break there.
And your home equity line of credit follows suits up to $100,000, but you can use that for anything. So most people are familiar with the fixed rate mortgages.
Right.
There's also adjustable rate mortgages.
Which is not for everybody.
Not for everybody. But if you're going to be in your house less than 5 years, you may want to look at an adjustable rate because it's going to have a little lower interest rate, but doesn't void the fact that you get the tax deduction on the interest.
Gotcha. And what else do you think people should know and keep in mind when they, when they are investing, bottom line, whether, I mean, there's just so many options out there as a rule of thumb.
Well, if you have high interest rate consumer debt like credit cards, you can roll that into a home equity line of credit. Just got to be careful if you do that not to run your credit cards up again. You have to be very disciplined.
So kind of lay off of them.
But you have to correct. And you have to focus in on your debt or your leveraged side of your balance sheet as much as you do on the asset side of your balance sheet. Because as you assess all of that, you're going to find out which one is going to be appropriate for your particular scenario in your life. And then just be cognizant that you need to do your research. Make sure you get the things, the types of loans are going to best fit you, going to have the best interest rates, and they're going to have the tax advantage that you're looking for.
Gotcha. Go see a financial advisor, basically, to do all that, which is what you do.
Exactly. You always want to check with your financial advisor because there's lots of different ways that you can use your investable assets, your portfolios, for instance. At Schwab, we can set you up with something called margin as well as a pledged asset line of credit. Both of those may not be for everybody out there. You have to understand the risks involved with that, but they can be tools to use to your advantage if it's and that's really something you need to discuss with your financial professional. And
one last thing I asked you during the commercial break, which I found to be very useful information, is that there really is no minimum amount that you can use toward investing. I mean, you can have like $5,000 or maybe even a couple thousand.
It's probably a misconception that you have to have a lot of money to invest, and that's not really accurate. And as I mentioned, we can show you many studies where if you were to start investing today, and that's the key, even if it's $100, that will grow over a period of time if you continue to add into it. I mean, even if you used 1 day's worth of Starbucks, $3.50,
there you go,
and started to add that to an account over a longer period of time, you'll find that that'll grow into something that would astound you over a 10 or a 20-year time frame.
Long-term growth. Mike, it's always a pleasure talking to you.
That's
always
good.
learn something new, I tell you. Thanks so much for coming in.